Hello, my name is Troy Emory, Managing Partner of TD Emory CPA and Associates. Today we're going to talk about the new tax changes in reference to businesses, LLCs, corporations, all the pass-through entities, and all the good things that are coming out as far as the ways to save you money on your taxes, especially you business owners. There are going to be changes as far as the different tax rates. Tax rates are going to be much less, that is. Personal exemptions are gone away. No more personal exemptions, but the tax rates are supposed to make up for that. In most cases that we've seen, the tax rates do make up for the lack of personal exemptions. Child tax credit, it used to be $1,000, now it's going to be $2,000. Limitation on state and local taxes. This is when if you own a house or your taxes on your Schedule A, they're going to be limited to 10 grand. AMT is going to go away. If you know what AMT is, if you had AMT, you know what AMT is. It's a minimum tax. That's going to pretty much go away until you get up to incomes of $1 million. And then later we're going to talk about some planning opportunities. I'm trying to go real quick because I'm trying to get to the business. So here are your rates. Let me see if I can get this right this time. This is the 2018 rates. The gray are the 2017 rates. As you notice here, we cap out now at 37%, and you can't see this because this bar is here. But in 2018, the top rate was 39.6. So the rate does help you. If you compare the rates here, 32%, 28% as opposed to 24%. You got 25% as opposed to 22%. So the rates do help you. And just about every case that I've seen, the rates do make up for the lack of exemptions and other things that they've actually taken away from taxpayers. The cap on the $10,000, the rates usually make up for those things that you're losing. All right, so this is just a rehash. Your standard deduction is going to be increased to $24,000 for married filing jointly, $12,000 for others, married filing separate, single, head of household is $18K. This used to be $12,000. I forget what all these were, but this used to be $12,000. So not only will you have better rates, but the standard deduction gets higher. This is really so that less people itemize on their tax returns. This is what this is for. And this is where I guess the president is talking about simplicity. Not as many people will have to actually do a Schedule A, okay? So in that regard, it is simple. One other thing that I forgot to mention here, if you are over 65, you get additional standard deduction, $2,600 if married filing jointly, $1,300 for if it's just one person. For your spouse. So in this case, if you have a situation, let's say like Donald Trump, he's 72, I want to say 72 or so, but his wife is I think 46. All right, so he would get $1,300 because he gets half of it because both spouses aren't over 65. He would just get the additional $1,300. Okay. And then if you're single, $1,600 additional if you're over 65. All right. Again, this is what you lose. You're going to lose the exemptions. You're going to lose the state taxes over $10,000, child tax credit $1,000, but your child tax credit is going to be $2,000 this time. It's going to be $2,000. What you gain: higher deductions, lower rates. Here you go again. The new child tax credit, it's going to be $2,000. $1,400 is going to be refundable. $1,400 refundable means $1,400 is pretty much guaranteed out of the $2,000. You may not be able to deduct $2,000 depending on your tax liability. Refundable means if I have $2,000 tax liability, I can use the whole $2,000. If my tax liability is say $1,500, then it's going to wipe out $1,400 of it, and I can't really get a credit for the other $100. Okay. All right. So this pretty much is going to says the same thing. Mortgage interest, I skipped this one because we talked about this a few times. Mortgage interest is going to be limited to your acquisition debt up to $750,000. It used to be $1 million, so that's going to hurt some people. Your medical expenses is going to be 7.5% of AGI. It used to be 10%. Moving expenses completely gone. All right. Miscellaneous deduction. This is the one that I see people kind of take advantage of. They have high miscellaneous deductions, job-related expenses, and so forth. That goes completely away. Once your itemized deductions reached a certain amount, and your income reached $266,000 for single and $320,000, your income used to be limited. I mean, your itemized deductions used to be limited. Now there's no phase out on itemized deductions. So that's going to help people. They have high mortgage interest, high charitable contributions, and probably those are the only two areas that they're going to have to actually raise the Schedule A amounts. Like I said before, the state taxes are going to be limited. The moving expenses are gone. The miscellaneous expenses are gone. So really, the only real areas you can really play with here are the mortgage interest and the charitable contributions. All right. So we kind of hit on this before. Some things that did not get affected was the provisions when it came to efficiency products that you buy, electric cars that you buy. Those things did not get changed. One of the things that did get changed is no personal casualty and theft losses on the Schedule A anymore. The individual mandate for insurance goes away in 2019. So in 2019, you will not have a penalty if you don't have health insurance. Not for 2018. I hope you enjoyed the video that you just watched. If you got any questions or comments, please contact me at tdecpa.com or 301-474-1040. Thanks, and hope you enjoy your next video. Don't forget to hit subscribe so you won't miss my next video.